Hello and welcome to our market alert video for today, which is June 14, 2024. I am Ken Moraif. I'm the CEO and founder of Retirement Planners of America, and we're a firm that has a noble obligation, and that is to create as many SCWPers as we possibly can. And if you don't know what a SCWPer is, it's the acronym for Second Childhood Without Parental Supervision. We want our clients to retire, and when they do, we call them a SCWPer, and we want them to go play, have fun, enjoy, and not worry about all this boring financial stuff. We want to do it for you. So I want to dive into a very, very, very important week. A lot of economic data came out, and it was important. But before we dive into it, I want to share with you how weird it can be to be me sometimes. I like to go to business conferences, maybe 2 or 3 a year, where, to sharpen the sword, kind of understand what the future looks like according to the industry thinkers, artificial intelligence, investments, all that kind of stuff. And so I went to a conference in Nashville, and while I was there, apparently the people that run the conference thought that I'm some sort of a VIP. And so I just want to tell you that Keith Urban got his picture taken with me. And so, I thought it was kind of interesting that would happen. And so, it's funny because, he's a good looking guy, very fit, let me tell you. And in fact, here's his picture of the two of us. And you can see here, he's good looking, he's fit, I can see why the ladies find him attractive. But my daughters were like, "Oh my gosh, you were in the presence of Keith Urban? Oh my." And I'm like, yeah, your daddy is not he's on it. Also, what happened, kind of funny, again, strange being me, we went to the Grand Ole Opry, and our team, we all went together. There were 7 of us, and we're all sitting in a row. And at the end of the row, about 6 people down from me to my right, there's a gentleman who kept looking over at me, and then he looked back, and then he looked over at me, and he looked back, and finally he goes, "You're Ken Moraif, aren't you?" And I said, "Yeah, I am." And he goes, "I'm a huge fan. I listen to your show all the time." And I said, "Well, thank you. That's great." And he goes, and he keeps looking at me, and I keep looking at him. And finally I go, "Do you want my autograph?" And he goes, "Yes." So it's a strange world. I don't comprehend it. Anyway, let's talk about 4 major economic reporting that came out this week, or important events that happened this week that I think are going to impact your and my and our investments, and more importantly, what we should do about them. So first of all, CPI came out, and that's the inflation, the consumer price index, and it came down. And more so than was expected by all these economists that never seem to get it right. And so, oh, by the way, before I dive into this, you're probably wondering why I'm in a colored shirt and I got this mic in front of me. So I just got done doing our podcast, which, by the way, if you're not listening to it, you should. So I thought you'd be interested in seeing what I look like when I do the podcast. It's a creative endeavor, so I like to wear color. And I have a portable, like a James Bond suitcase that I carry all the stuff in, so I can do the podcast from anywhere in the world that has internet. So that's why this microphone is right here. But anyway, so the consumer price index came out, inflation, and it was lower than expected. That's a good sign for people who want the Fed to start lowering interest rates. It's a good sign for the Federal Reserve that's trying to get inflation down to their target of 2%, and it came down to 3.3%, headed in the right direction. So that's good. The other thing that happened was that the Federal Reserve Chairman himself, Jerome Powell, told us what they're going to do with interest rates. And what he said was, we're going to leave them where they are, and we're now making progress, but we did say we're going to lower interest rates 3 times in the second half of this year. We've changed that. We're going to lower it 1 time now. So that was a change, but still, the bias is towards lowering interest rates, so that's still good. The market likes lowered interest rates. It makes money cheaper, and if it's cheaper, then companies have more profits. And as we've said many times, profits, in our view, drive stock prices. So that's a good thing. The other thing that happened was we got the PPI number, the Producer Price Index. And if you don't know what that is, it's a very important number to measure what inflation's doing, because it essentially measures what the cost of producing a product is in our country. And of course, if the price of producing a product goes up, then what do businesses do? They pass it on to the consumer, and of course that's inflationary. Well, the PPI came down also more than expected, so that's a good sign too. And I'll get into why maybe all this stuff is not such a good sign. And the fourth thing that happened this week was we got consumer confidence numbers, and the consumer is apparently has lost a little confidence. Their confidence is going down. Why is that an important number? Well, 70% of our economy is driven by consumption, our consumers. And if they have high confidence, they spend money. And if they have low confidence, they tend not to spend money. And that could cause a recession. So overall, we see that the inflation numbers are coming down, consumer confidence is coming down. In general, it's a good sign from the standpoint of the Fed lowering interest rates, and the economy seems to be holding. However, here are the dark clouds that we see on the horizon that potentially could be significant. The real estate market, both residential and commercial, are really feeling the pain of these high interest rates. We see the numbers in terms of residential sales are dropping dramatically, and they're accelerating, and that's not a good thing. The other thing that's happening is that commercial real estate, which is hundreds and hundreds of billions of dollars that are coming up for their refinancing, are going to have to refinance at much, much higher interest rates, and that could cause a rash of bankruptcies in the commercial real estate area, and that's a significant risk. So the real estate represents 25% of our economy, and so if that goes into a bad recession, it could pull the whole economy down with it. Other parts of the economy are also starting to slow down and at an accelerating rate. So the challenge that creates is that our economy is like a big oil tanker. You don't turn it on a dime. You have to start turning it way in advance. And if the Federal Reserve waits too long to start lowering interest rates, then what could happen is we could go into a really bad recession, and now they're behind the curve and they have to act aggressively. That could be very disruptive, and we could have a bad situation. This is exactly what happened back in the early 80s with Paul Volcker as the Federal Reserve Chairman. So there is the possibility that we could have that. Now, we don't see that. We think it's going to be okay, but we always believe that you plan for the worst and you hope for the best, not you plan for the best and hope the worst doesn't happen. We don't think that's a good idea. So in our firm, we have a strategy we call invest and protect. This strategy is designed to help us if the market does fall off a cliff, to protect our clients as much as possible. Our strategy did tell us to get out in November of 2007, before the stock market crash of 2008. It told us to sell literally the day before the pandemic was announced. And you know what happened after that. The market went down significantly. And also in 2022, with all this inflation, same thing. So we want to help protect against. So we want to have a strategy for that. And if you're over 50, retired or retiring soon, we think it's paramount. So visit with us if you'd like to talk about that. All right, so thanks for watching this video. Please share it with as many of your friends and business associates as you can, and we'll talk soon.